Hey, welcome back, everybody, to the Mic Drop Show. Good morning. This is where we talk about real estate, real freedom, and real results. And I'm your host, Mike Morawski, the multifamily bounce back coach, investor, educator, and your go-to partner in cash flow when it comes to building real wealth in real estate without burnout. Hey, today's guest, he's raised more capital than most people are going to see in a lifetime, and he's just getting started. I'm sitting down with my good friend, Michael Guthrie, founder of Pacific Capital and WMG, two firms managing over $2.3 billion in assets with a sharp focus on capital, credit, and real estate-backed investments. With over 30 years in the game, Michael's helped fund managers, advisors, entrepreneurs raise more capital, smarter, scale faster, and build wealth that actually lasts. So if you've ever asked yourself, how do I build capital without sounding desperate? This one's for you. So if you like what you hear this morning, smash that subscribe button, follow us. We're here every Wednesday morning. And if you have questions, drop your best questions and comments in the DM this morning or email me directly. We might make your question one of the next ones on the Mic Drop Show. We're here every Wednesday morning. Let me bring my guest in this morning. Michael, how are you?
I am amazing. Thank you. What a wonderful introduction.
Oh, man, you deserve it. That's for sure. You're my hero. I love that.
I don't know about that.
Well, hopefully I'll grab a couple golden nuggets from you this morning, and hopefully we'll be able to pass some of those on to some other people. So, hey, I've got to ask you one question. I saw a post that you posted on LinkedIn about a $100,000 investment, and I was really intrigued when I read that. Do you know which one I'm talking about?
I believe I do.
I would love for you just to talk about that post and talk about that a little bit. And if people aren't following you on LinkedIn, they need to be.
So what I was basically trying to explain there is that you could put $100,000 in the stock market, $100,000 in a debt fund, and or $100,000 in a multifamily or a large real estate investment like multifamily, self-storage, or trailer parks. And when you get the gains and you cash out of a stock, you automatically have a tax implication of like real-time money that you have to pay. Whereas real estate grows in value, it's a paper gain until you exit, or you can 1031 out of that into another property and continue to grow that, or you can invest it into a debt fund that pays you out a monthly return on your investment of say 8 to 10%. Based on whatever that fund is paying. So there's different ways to make it, but in the stock market, your value can go up and down based on whatever the stock's doing. So you can actually lose money in that 100 grand. In a debt fund, your 100 grand is typically invested as a loan into a property. So your 100 grand is always going to be there, and your interest rate will go up or will actually return to you. And then in the multifamily space or the self-storage or trailer park space, the value of the asset typically goes up, but sometimes it comes down like it has over the last couple of years. But with the real estate, like a large multifamily or large self-storage or trailer park investment, those will typically go up over time. While you may actually see a paper loss out of the gate in the form of a K1 depreciation benefit to offset some of your current taxes, the asset typically over time will go up significantly, and you'll make a ton of money on those long-term assets.
Yeah. When I read through that post this morning, I read it a couple of times and I was like, wow, this makes so much sense why it's, there are smarter investments than others to be involved in. And, you like me, we've been in this business over 30 years, and, so with that much of time, like me, you've seen up and down cycles, and we both know that this is, I don't know that there's any geniuses in this business. There's market cycles, and where we're at in the market cycle right now, what do you see going on and what do you see coming in front of us?
So great question. Where are we at today? We won't know exactly where we're at today for probably another 12 to 18 months, but in my heart, based on the way cycles run, I believe we're at the bottom and we're starting to come out the other side. Why do I believe that? Because sellers actually have gotten real with the assets that when they have to sell them, and they've actually discounted their prices to the right part. But I'm also starting to see increasing prices in some of the multifamily and self-storage assets because the vacancy rates are so low, the values are actually starting to creep back up. But we won't really truthfully know what the bottom is until we really start to escalate out. And like you said, how do you, it's not timing the market, it's time in the market and time in different cycles. And some cycles last longer than others. And they're saying the peak of our next cycle is what's been predicted based on the trends going back to the early 1900s. 2035 will be the peak of our next cycle. So if that's the peak and we're in 2025, we're actually starting to see the climb out. While some of the single family has softened up a little bit based on interest rates, I believe with inflation being where it's at, as they've decreased it to almost nothing, we're actually going to start to see the Fed pull back on the rates a little bit over the next 6 months. They promised us 2 more cuts this year. So we'll see if that happens. I mean, we have another meeting coming up end of this month, around the 26th or 27th.
Right.
And I would anticipate being the 7th month of the year and they promised 2 more rate cuts. If we don't get one this month, we are definitely going to get one on the very next meeting. So I don't think they can do any better with decreasing unemployment. Like literally in Arizona, unemployment's 3.1%. Everybody that wants a job has a job and is working. The rest of the people aren't looking really to work. And that's what's going to keep the inflation or the inflation low, is the unemployment rate staying really low.
Yeah. So, it's been an interesting ride, these markets, and you pinned it, right? Like the peak of the next one could be 2035, right? And these markets go up 8 to 10 years and come down 8 to 10 years. And there's no doubt that we're at the bottom, and I always say that the media has so much to do with where we're at, because they put this fear into the marketplace. And, if you take the media out of it, what has to happen? Is it just interest rates coming down in order for us to move out of this down period? Or
I believe so. If you look back and you think about the mortgage rates, and people are locked in at their 3 and 4, 5% mortgages, where mortgages on single family homes are trading right now around the 7s, unless you do a buy down of some sort to buy down your rate. If we can get the rates down around 5% again on home purchases, people will be willing to leave their 3 or 4% mortgage to buy a bigger property, because they have that much equity in that property and they can actually get money out to go and leverage upwards, as opposed to just doing a lateral transfer. For a lateral transfer over the last few years, it doesn't make sense to go from a 3% or a 4% mortgage to a 7.5% first position mortgage. So I think interest rates definitely have to soften up. The jobs market is on fire. The government's creating jobs. So anybody that really wants to work is working, and they're able to buy a home. Here's the other thing that's really the affordability gap is just crazy. Like the average household income right now is $75,000. The average median home price is $440,000. To afford a median priced home in today's market, you have to make $110,000. So being in the apartment business, that drives more of those folks into a long-term rental situation in an apartment, which is great for you and I that own a ton of apartments out there. It's going to help continue to drive that value up and make us want to trade out assets in the near future, maybe the next 12 to 18 months. Because I'm not seeing a lot of trading happening today. I'm seeing a lot of refinancing and restructuring of loans. And I could get into that. We just did one, a huge $40 million one. I did that with Brad Sumrock. Me and him were on a deal. We restructured a whole $40 million loan literally 3 weeks ago in New York City. But there's not a lot of trading going on in the smaller asset classes, the single family homes. So until we see interest rates come down and get those folks to start trading out, and with Trump in the White House, He's a real estate guy, and he likes he likes to see money moving, and without lowering the interest rates, money's not moving.
Yeah. And hold that question, or hold that thought for a minute, because I want to talk about this bill that Trump just passed. But before I go there, I want to, we've been in the business since the 90s, right? And, I remember when I first got in real estate, interest rates were just coming out of double digits. And not too far before that, they were at high double digits, right? High teens. And, coming out of double digits, I remember saying, boy, I wish I could buy a house at the mortgage rate my parents bought one at 3%. And then we got there, right? But it took us 50 years to get there. Really, when you look at mortgages today at 6 or 7%, that's a pretty normal place in the market for those to be. What do you say to people who are saying, well, interest rates are too high, I can't invest, or I can't, put any money into, buying real estate myself or going in a syndication? Do you have thoughts around that at all?
Absolutely. So you and I are old enough to know that back in the 70s and 80s, interest rates were double digits, and that was the normal back then. And then it became in the low single or high single digits. And then over the last, in the 2010 to 2020-ish, they were in the 2 to 3% range, or 3-4% range for people to be able to buy properties. So people that are actually in the market that are probably 10 or 15, 20 years younger than you and I, all they've seen are these low single digit mortgages. They've not had that experience. So they don't feel that that's the norm, or that should be the real deal. You and I believe that even 6 or 7% money is a discount on money. You know what I mean? But most of the buyers in the buyer pool out there, they don't believe that. So they would rather hold on to their money and not risk it. And what I always tell people is, if you don't risk anything, you're never going to get any rewards. That's number one. Number two, nobody ever put money in a savings account and saved themselves to true wealth. That's not true. And people your age, my age, and baby boomers that are retiring today that do not have a 401k, do you know the average amount of money they're retiring with cash in the bank?
How much?
Between $75,000 and $125,000. That's the amount of liquidity they have of cash in the bank. And then the opposite of that is the folks that had a job with a 401k. An average 401k right now for a person retiring has $232,000, almost double what somebody that never had one versus somebody that had one. In my mind, and in my budgetary constraints of the way my household lives, and I don't know exactly where your household lives, $232,000 in a 401k, if I had to retire today with that amount of money, wouldn't last very long. I'd have to completely change everything about the way I live and the way I operate. So you have to invest money. So I would always recommend, you need to be putting money into something. Warren Buffett says, invest when? Always, monthly. Every time you get money, put something away into the bank. Maybe 30% of your income, use the other 70% to live on, 30% put away, so that you can actually afford to, when it's time to retire, not change the way you're living today to retire tomorrow.
Yeah. And, people don't get that message, especially younger people, which is interesting. Hey, so what's your take on this bill that Trump passed with, now bonus depreciation's back to 100%, and, opportunity zones are indefinite now. What's your take on that? Have you read into it? What are you hearing out there?
I've not read a ton. I've seen, I understand the bonus depreciation's back. Will that move the needle? I think it's going to get some people to start trading assets, but the only way they're going to get people to actually trade assets is to pay more than what they're actually worth today. Because today, with the interest rates high and cap rates are high or higher, the value isn't there to get people out of their current loans. We literally had some BOVs done in the last 2 months on a bunch of our properties. What we're hearing from the brokers are that we're in good position because our BOVs are actually worth more than loan value.
Mhm.
where most of the stuff they're going out doing BOVs on are worth less than loan value. So it's hard to get somebody to trade a larger asset when they can't sell it for what the loan value is. That means they'd have to put cash in to get out. And then that would be a complete investor equity wipe. And nobody wants that. So people are holding on, hoping that rates start to come down and that they're in a better position to, one, either refinance out or get somebody to come in and pay a little bit more than what the loan value is so they can get out from underneath that asset.
Yeah, it's an interesting environment. What do you tell, I know you do a lot of high net worth investors and some institutional investment dollars, but what do you tell the common guy and woman out there today that is sitting on the sidelines and they have fear going on about where the market is and the uncertainty, and what do you tell them about investing today and why they should jump into real estate?
That's a great question, and I'm formulating my answer. You want to be running towards something when everyone else is running away.
Mm.
So right now, the institutions aren't coming into the market because the cap rates are where they're at, and so you want to be going in. And when the money's not coming in, that's the time to put the money in. People are running away from some of these assets, and you got to be running towards it, because what we're in now is a space and time like 2008, when everybody had fear of buying too much real estate. And when you look back at 2008, everybody said, I wished I would have gobbled up every piece of real estate I could have got my hands on because it was at a discount. There's a lot of discounts out there, but the money's not following it. There's a lot of dry powder sitting on the side looking for a better buy. I literally am a partner on an asset, and we have executed our business plan. We're doing $2,000 to $3,000 a month distributions to our investors. And we're done with our plan, and we put it on the market. And we've had it on the market since the beginning of June. We called for offers at the end of June. We had 4 new tours. We have 4 more tours going on today. And people are throwing us lowball offers, even though our NOI has went from here to here. We bought the asset for $9 million. We put $3 million down. If it was trading at the same place it was trading 4 years ago, we would be selling that property right now for about $26 million. Mm-hmm. We're getting offers right now around $10, $11 million, and the offers should be coming in the $16 to $18 million range. We could be 3Xing, 4Xing some of the investor dollars, and that asset is performing. We had a fire. We had a whole building burned down, and that building is ready to go. The problem is it's performing too well for what the market wants to pay. So I'm just telling our partners, I go, why don't we just sit and hold for another year or two and continue to pay distributions, keep the investors moving at the right direction, or throw a little bit of money at Freddie Mac and buy down the rate and refinance the thing into a 5% mortgage as opposed to 6.5%, and trade it, give everybody their cash back out. So now we're playing with house dollars at that point in time, and we just continue to roll forward. I mean, it's making that kind of money. But anybody that's sitting on the sideline today, you should be putting money into something. And my hot asset class is real estate, whether it's in a fund that buys gas stations, buys trailer parks, buys multifamily, buys self-storage. Get your money out there working, doing something, because the inflation that they're reporting isn't what true inflation is. If you've been to the gas pump recently, and I drove from Scottsdale through California to here, and I got through California before July 1. On July 1, and gas in California was running right around $5 a gallon. July 1, there was a 65-cent gas tax that went into effect July 1 in California. So that $5 a gallon would be $5.65. So prices are going up. And if you look at that, that's over a 10% increase in gas. So sometimes when they report inflation, it's not based on what we're consuming, like apartments, housing, food, gasoline, electricity, those things that have gone up. They're putting into the bucket things that don't really make a difference to most people. Gasoline, food, and housing are what make a difference to everybody. So if your money's not making you 5 to 10% a year, or annualized increase, your money's actually going down in value. So say you put $100,000 in a savings account, not investing it, but in a savings account, and let it sit there for 1 year, making 0.1%, which is what Bank of America, Wells Fargo, Chase, all the big boys are paying on their checking accounts. Come next year, that if inflation stayed at the 2%, your money would be would have $98,000 worth of buying power. But inflation is more like 8 to 10%, so that money would actually be worth around $92,000 in buying power.
Yeah, it's crazy. Hey, I have two more questions I need to ask you here this morning, and we're kind of bumping up against time. But the first thing is, what asset class? Now we know real estate, right, as an alternative investment, but in real estate, what asset class excites you most today?
Multifamily still excites me.
Still,
I truly believe it's a great time to be buying. The hardest part right now is raising more money and raising awareness. And in the family office space, people are buying real estate for data centers, but it doesn't matter if you can just go buy a piece of land. You have to buy a piece of land that has a certain amount of electricity allocated to it. So you're not only buying the land, but you're buying electricity contracts. So that excites me also. I'm not into that space yet. I'm researching that space. But when I spoke at Family Office Club, literally in March this year, a number of the high net worth families that are there speaking, that is what they're investing in today, other than their long-term holds in the multifamily space.
Yeah. So, I love what you just said, and I'm not going to spend a lot of time on this, but we're doing a deal right now. It's a light industrial deal that has a solar component to it that we're producing another $65,000 a year in revenue from the solar on a building. And, the returns are above average for the passive investor. And so there's opportunity there. The other thing is, and this is a question that came in from a listener over the last week here, and they were asking, what is one of the red flags that you look for when you look at a slide deck or a pitch deck on a deal, right? So somebody says, hey, Michael, I have this multifamily deal. I need help raising capital with it. What are some of the red flags you're looking at today in those offerings?
That one's loaded, because a guy came to Phoenix. I have a lot of respect for him, and they're buying RV parks. And he goes, my IRR on this RV park is going to be north of 20%. And I go, really? I go, let's just take that same $100,000 I'd give you today, and let's move that back to 3 years ago. And I put that in your XYZ fund. And I'm not going to say what it was, but your XYZ fund that you were promising a 16% IRR then. I go, what's your IRR now on that? And he goes, it's really nothing, because we're not making any money. And I go, well, then let's talk about what we're actually going to be able to return to investors, because we project IRRs and we project cash on cash, and we project this. How much do we have to raise and put down on an asset today? Let's talk about how we're protecting investor dollars today by really securing a good position in the asset, say a 40% down, something a little higher, so you can actually have cash flow returns without worrying about the appreciation and talking about appreciation. Let's talk about how we're securing and protecting investor dollars, because that's the only way we're getting investor dollars today, is by how do we protect it? When I put $100,000 in, am I going to get my $100,000 out? And we will, because we're putting 35-40% down on an asset, instead of like what we were doing 4 or 5 years ago, putting 20% or 15% down and leveraging that property way too much, to where right now, if you can't get out of the debt, or you didn't increase your rents good enough, the debt's strangling the property. So we want to make sure that we're getting proper debt and proper leverage when we're buying properties today.
Yeah, 100%. Well, listen, I want people to know that you are going to be speaking at my summit coming up in October this year, and super excited about having you on this year. Brad's going to be on.
Awesome.
Have a couple other big names this year. It's my 6th year, so really excited. We're just doing our soft launch right now, so anybody listening who's looking to get a ticket, make sure that you reach out. we'll get you tickets to that 2-day virtual event. We're going to have speakers like Michael, but I'm super excited about having you on this year. Michael, tell people how they get a hold of you, if they want to talk, markets, real estate, capital investments.
Michael Guthrie on LinkedIn, or Michael Guthrie Investor, or Mike Guthrie Investor on Instagram, or text me at 509-270-6701 and let's jump on a call and have a conversation. I love speaking about real estate, and I really enjoy all my time I've spent with Michael over the past years.
Yeah, you know what? I always enjoy talking to you, and I sometimes I feel like, man, I could talk to you for hours. Just talk shop, right?
Feelings mutual.
Yeah. So, hey, I'm looking forward to seeing you soon somewhere here on the road. I know that we're like two ships passing in the night sometimes. Just real quick on gas prices. God, I live in Southern California. Gas is like 475, 480, right? I am in Myrtle Beach, South Carolina today, and gas yesterday I put gas in my car for 259. You go explain it.
I'm in Coeur d'Alene, Idaho.
Yeah.
325. That's for mid-grade gas.
Yeah.
So low gas is right around 299. But yes, you can't. How do you explain that?
I don't know. I don't know, but hopefully somebody powers greater than us can straighten some of that out.
100%. We really appreciate you having me on today.
Yeah, thanks. I'm going to move you out and go ahead and say goodbye. And can you still hear me?
I can.
Okay.
Jeez Louise. Oh, ouch.